You are self-employed. You have an absolutely amazing CPA, and therefore you're pretty sure you don't qualify for a mortgage unless you file taxes with a lot of profit on there, but you don't want to do that because then you're going to pay a bunch of taxes to the IRS just to get a mortgage. It's not worth it. Bank statement loans are one really good option for you. I've got lots of options, but bank statement loans is what I want to talk about today. Now, you may have heard before about bank statement loans. You've heard maybe they're a good idea, but you always have to pay a higher interest rate. That's probably not worth it. Let me dispel those myths for you today and help you understand exactly how bank statements work in 2026. Now, this information is ever changing in this market, but here at Cross Country Mortgage, I have a portfolio loan that offers me flexibility that no other lender offers. Let me explain what bank statements are. Let me explain how all lenders look at them, and then let me explain to you how we look at them different. So first and foremost, a bank statement loan simply says, let's look at the deposits into your bank account as your revenue, and let's apply an expense factor. That expense factor is typically 50% of your deposits are written off as expenses. Now, just off the surface, that may qualify you for something you've never ever qualified for before, meaning it'll get you qualified because that's enough income. For a lot of people, that's all we need. Their fear is it's not worth it because it's such a higher interest rate. Well, in today's market, at least with my company, that isn't true. It is higher, but a smidge. Depending upon your credit and down payment, sometimes it's the same rate as what conventional loans are. Sometimes it's maybe 0.25% higher. And it gives you so much more flexibility. Even if you're paying 0.25% higher in interest every single year, that's way cheaper than what you would have spent to pay the IRS the taxes on the profit that you earned. And guess what? If you end up showing for 1 or 2 years a significantly higher profit, you pay taxes on those higher profits, and then you go back to your normal lower profit. And then 3 years later, 5 years later, rates drop, you want to sell and buy something else, you got to raise your profit again. You pay taxes again on the higher profit, and you flag yourself for audit. You tell the IRS basically, yeah, I really make this much profit, but I'm showing you a lot lower number because I don't want to pay you taxes. And you're creating a situation where the IRS knows your playbook and they literally have proof to use against you. That is a horrible idea versus pay a little bit higher in interest rate, maybe nothing higher, and you end up getting a bigger tax write-off, even if you do pay a little bit higher interest rate. So it really doesn't hurt you that bad. Now, I'm not a fan of paying more in interest simply to get a tax write-off, but the fact is you save a significant amount of money in your taxes because you didn't file with higher profit. Now, here's what's different about my company. We will look at common sense. We will look at your business. If you are a product-based business, the truth is your margins are a lot lower than 50%. So we're being generous by giving you 50%. But if you're a service-based business, you're not paying for your cost of goods sold is zero. You're not selling any goods. So you have higher margins. If you're a one-man shop, independent contractor, consultant, you work out of your house, your expenses are next to nothing. Now you show the IRS a lot of expenses, but the truth is your expenses are next to nothing. Then I look at that and say, well, gosh, if you're a CPA, you'll just check a couple boxes on a piece of paper that says, hey, they're a service-based business. They've been in business for over 2 years and they have 0 employees other than themselves. Then I get to count 85% of your deposits. Think about that for a second. Let's pretend that you deposited $120,000 last year. Now, on your taxes, you wrote off $100,000 of that. That means you have $20,000 of profits, which is less than $2,000 a month. General rule of thumb, you can qualify to spend about half of what your monthly income is, which means if you use your tax returns, you qualify for about $1,000 a month mortgage payment. I don't know about you, but there's nothing out there to get for $1,000 a month. So you say, oh, you know what then? I'm going to use my bank statements. I show the $120,000 going into my bank account. And that's great. And every other lender is going to say, well, hey, we're going to use 50% of that. We're going to use $60,000. You're going to get $5,000 a month in income. Way better than the $2,000 that your tax returns would have given you. But you only qualify for a $2,500 a month house payment. By the way, this is assuming you have no other debt, no credit cards, no car payments, no student loans. So when you think about it, that might not get you where you want to go. And now you're saying, see, this is why bank statement loans don't work. Well, I've got one better for you. Because if you're a service-based business and if you have 0 employees, I automatically count 85 cents on the dollar. which means that you're going to have significantly more income. You're going to have, $8,500 a month in profit, because your $120,000 in the last year of deposits is $10,000 a month in deposits. Instead of counting half of that, or $5,000, I'm counting $8,500, which means I can qualify you for a mortgage payment of $4,250. And we can combine it with a cosigner, your spouse's income. Somebody else is buying with you, that maybe they're not self-employed. Maybe they've got a W-2. I can combine that separately as its own income source to qualify you for even more. I have a lot of flexibility in helping to make this happen, and we make a lot of exceptions to the rules because we are lending our own money. Cross Country Mortgage is the largest retail mortgage company in the nation. We do more of these alternative type of loan programs than any other lender out there, and we fund them through our own pockets, which means we get to make the rules. And when we make the rules, we get to decide when we make exceptions to the rules. And so if you're thinking, I'm self-employed, I don't think I qualify for a mortgage, it's not even worth trying, I don't want to show a whole bunch of profit, that's just one method. I've got another method that we could use your P&L. As long as your CPA prepares it, all I need is your P&L to show how much profit that you have, and that's what I count for your income. Like, there's a lot of ways that we can get creative and legally get you a mortgage without spending a bunch of money in extra taxes. So if you're stuck thinking, I have to file taxes with more profit in order to qualify, call me. I have options, and I'd love to help talk you through them. Thanks for listening. Hope you have a wonderful day, and check out the rest of my videos. We've got a lot more great information about traditional and non-traditional loan programs to help you and anyone that you feel that you want to refer to me to help them out in their purchasing and refinancing of a home. Have a great day. Bye-bye.